Hi, my name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I discuss the practical considerations to help tech innovators grow their Canadian businesses while taking advantage of the best tax planning opportunities. You see, COVID-19 has fast-tracked digital transformations within every industry. For example, since March, online retail growth is booming. For BC tech firms, the technology sector continues to grow, especially here in Vancouver, contributing to its recovery. You might ask why Vancouver? Well, it offers an excellent geographical location with an international airport and not far from Seattle's major tech sector. It also offers smoother immigration as compared to Seattle. You see, there are many complexities involved with the growth of a new business when you are a startup technology company. So you must balance your technical expertise with business knowledge. This means applying your adventurous qualities to your tax strategies. Let's talk about the SR&ED credit. The SR&ED credit is a refundable tax credit that gives startups cash back for research and innovation spending, assuming certain criteria are met. It is the largest federal incentive program for innovative businesses in Canada. The tax incentive is managed by the Canada Revenue Agency, which is also called CRA in short form. Unfortunately, the number of companies applying for these schemes is still small, even though many are eligible. It may be that you are eligible even if you don't think you are conducting research and development. You see, to fit the criteria laid out by the CRA, your project must meet three standards of technological uncertainty, technological advancement, and technological content, in addition to the condition that your business is carried out in Canada. You see, the SR&ED credit is one of the most significant domestic tax credits remaining under the current tax law. It is an important tool for maximizing your company's value. If your company is eligible, you can recover up to 70% of qualifying expenditures in refundable and non-refundable tax credits depending upon the province you are in. Examples of qualifying expenditures include expenditures made for engineering and design work, operations research, mathematical analysis, computer programming, data collection, etc. It is important to note that not all research and development is considered scientific or experimental, and SR&ED specifically does not include things such as market research, quality control, research in social sciences, commercial use of a new or improved process, or capital expenditures, etc. The government allows you to claim overhead on your research and development expenditures as well. Today's successful SR&ED claimants isn't necessarily the company making the biggest, most apparent advances in technology. Still, rather, it's the company with enough precision in their project methodologies to closely monitor and capture the key facts about the work being performed. If you have a dedicated R&D facility, this is easy to do. Still, if R&D is part of your overall operation and you do not have strong accounting systems, you may have difficulty tracking overhead specifically related to SR&ED. To facilitate you, the government allows you to claim an overhead proxy, which amounts to 65% of your direct cost. For example, let's take a Canadian controlled private B2B fintech company with an office in Vancouver and 6 full-time T4 back-end developers. For every dollar spent on the developers' salaries, the fintech company can expect to receive up to 68% back in cash. So, for the sake of simplicity, assuming all 6 developers are dedicating 100% of their time to eligible R&D, at $75,000 per developer and a proxy overhead of $48,750 per developer, the SR&ED tax credit will yield you a maximum cash refund of $308,000. Another important thing which you need to remember is that if your business benefits from and has applied research and development credits, it is essential to understand how these might change in the event of the company's sale through a merger or acquisition. You see, the buying company's size and nationality can make a big difference in what level of support is provided. For example, your Canadian Controlled Private Corporation or CCPC receives a federal refundable investment tax credit of 35% on qualified expenses up to $3 million. Let's discuss the Industrial Research Assistant Program or IRAP. You might ask, what is the difference between IRAP and SHRED? You see, the Industrial Research Assistant Program or IRAP is another government incentive for small and medium-sized businesses. IRAP provides technical and business innovation advising as well as financial assistance. Please keep in mind that IRAP provides funding to help start the projects. On the other hand, the SHRED programs helps repay a portion of the expenses after the costs are incurred. Bear in mind that unlike tax credits, grants cannot be applied retroactively. Application must be filed and approved before the eligible expenses are incurred. Let's discuss employee stock options. Distributing equity is common within the tax sector. When correctly implemented, it can help your company attract and retain top talent. It encourages employees to adopt the ownership mindset. In this option, your company promises to your employee to allow them the right to buy shares at some time in the future, but at today's price. Another potential benefit is in the area of bonuses. A company can pay employees in shares instead of cash. If the company qualifies, the employee pays no income taxes on the shares until they sell those shares. There are several important restrictions on this benefit as well as some downsides from a tax perspective. So therefore, your employees must have a full understanding of these methods, pros and cons before using bonuses as a means of funding an ESOP. An employee investing in a qualified small business can be eligible for a lifetime capital gains exemption as defined in the Income Tax Act. This means that upon the sale of the shares to a third party, there is no income tax payable on the capital gains portion. The exemption is currently about $883,000 and it changes yearly with inflation adjustment. Selling your company. As an owner of a tech startup, you might also need to think about eventually selling your company. So you will need to be aware of all the due diligence steps of that process. If you have a Canadian controlled private company and if you've been operating and holding the shares for longer than 2 years, there are many tax benefits and a lower capital gains rate. As mentioned earlier in this video, Canada does have an $883,000 lifetime capital gains exemption on capital gains realized by Canadian residents upon the sale of shares of certain CCPCs. This capital gain exemption has been a great bonus for small business owners in Canada. But tax planning strategies and its implementation has to happen well in advance of selling the company. Suppose you get bought out by a large Canadian-based company or foreign-based enterprise. In that case, the SHRED tax credit rate drops to 15%. The SHRED credit is no longer refundable. That is, it can only be applied to offset other taxes actually incurred. Please be advised that this change might adversely affect the corporate cash flow and your business valuation at the time of sale. Transfer pricing. Companies conducting international transactions are subject to further tax obligations under the transfer pricing rules. This refers to the pricing of international transactions between two entities associated under a common corporate umbrella. While it might seem natural to view such labs or arrangements as simple innovation cost centers, because they are not generating revenue, the tax laws in this area are broad in scope and in most cases will require profits to be recognized by the innovation center at least to some degree. Given the current unique COVID-related economic environment, taxpayers will need to defend their transfer pricing not only through more strong comparable economic analysis but also through stronger quantitative analysis such as industry analysis to demonstrate that any intercompany prices selected and thus reported profit meet the arm's length standards. You see, a chartered professional accountant can provide practical business techniques to solve your problems and help you manage your company's growth. If you want to be notified about my new tax updates on tax planning tips and tricks, please consider subscribing to my YouTube channel. Thanks for watching and see you in my next video. Until then, bye.